Hey everyone, and welcome to The Explainer. Today, we are tackling a subject that is honestly tearing the financial world right down the middle. If you just gauge the current sentiment out there, some folks are literally calling Ethereum dead money because of recent price drawdowns. But if you look under the hood at what the biggest institutional players on Wall Street are actually doing, and more importantly, what their financial models are projecting, you see a completely different reality. We're going to dive deep into the wildly varying Ethereum price predictions floating around right now. We're unpacking the whole shebang, from this massive wave of institutional adoption to the major fundamental technological shifts happening on the network itself. Make no mistake, this isn't just about drawing lines on a price chart. We are talking about a fundamental, ground-up repricing of a global digital asset.
Let's just jump right in with a provocative question to anchor our whole analysis today. Is Ethereum actually headed for $15,000 by the year 2027? Now, this isn't just a random moon math number. This is a highly specific forecast detailed by CryptoRank and Etherealize analysts, and it is entirely driven by Wall Street infrastructure. The thesis here completely shatters the tired narrative that ETH is just lagging behind other assets. Instead, it suggests a profound phase change is underway. We're looking at a scenario where recent U.S. regulatory clarity has basically unlocked a tidal wave of institutional adoption. It's turning Ethereum into the core financial plumbing for major Wall Street players.
And the sheer scale of this thesis becomes even more obvious when we look at the long-term financial modeling. Take a look at this staggering projection from the asset management giant VanEck. They recently ran a rigorous valuation model and projected that Ethereum's network revenues could skyrocket from an annual rate of $2.6 billion today to a massive $51 billion by 2030. Just think about that multiple for a second. To put this in perspective, Standard Chartered has even floated a long-term $40,000 price target for the end of the decade. We are talking about trillions of dollars in value being modeled by traditional, heavy-hitting finance institutions. This instantly grabs your attention, right? Because it proves we aren't just talking about some highly speculative token anymore. We are talking about a massive, cash-generating software network.
Okay, so here's our roadmap for the explainer today. We're going to start with the trillion-dollar thesis, followed by Wall Street's new engine, and upgrading the digital mall. Then, we'll break down Ethereum's new business model, outline the bear and bull scenarios, and finally, look at the future of finance.
All right, kicking things off with Section 1, the trillion-dollar thesis.
To truly understand these new trillion-dollar valuations, we have to recognize a massive paradigm shift. The rules of the game, they've completely changed. Think back to the previous cycle, pre-2023. Ethereum's value was primarily driven by retail mania. It was the Wild West era of speculative DeFi yield farming, a total frenzy of NFT digital collectibles, and grand promises about future scaling. Don't get me wrong, it was exciting, but it was incredibly volatile and almost entirely retail-driven. Now, fast forward to the current cycle. The drivers have completely flipped to regulated institutional-grade mechanisms. We're talking about BlackRock ETFs accumulating billions of dollars in assets. We're talking about the tokenization of real-world assets, things like treasury bonds and real estate. Analysts on Binance Square project that specific market will hit $2 trillion by 2028. And we're seeing stablecoins being heavily utilized for actual, everyday global payments. It's a fundamental transition from a speculative retail casino to a heavily regulated institutional settlement layer.
Moving right along to Section 2, Wall Street's new engine.
So traditional finance isn't just sitting on the sidelines watching anymore. They are actively building on Ethereum and creating unprecedented financial vehicles to absorb its supply. Let's look at the hard numbers. Cumulative U.S. spot Ethereum ETF net inflows have already blasted past an incredible $12.05 billion. But the real game changer here, the deep structural piece that mainstream coverage seems to completely gloss over, is the launch of products like BlackRock's iShares Staked Ethereum Trust, known by its ticker ETHB. Why is this such a big deal? Well, because ETHB actually stakes 70 to 95% of its assets under normal market conditions. This is absolutely profound. A regulated Wall Street wrapper now functionally locks Ethereum out of circulation, physically taking it off the open market, and passes that staking yield directly to U.S. institutional balance sheets. They don't have to hire engineers or run complex validators. They literally just buy the ETF. And from a legal standpoint, the IRS recently ruled that these ETF staking rewards are treated as ordinary income at the fund level. This is massive. It completely de-risks the asset, providing a safe, legal pathway for traditional capital to pour in. So you combine that with the $2 trillion projected real-world asset market, and you have this relentless engine of demand slamming into a rapidly shrinking liquid supply.
Which brings us to Section 3, upgrading the digital mall. Now that we understand the demand side coming from Wall Street, let's flip it and examine the supply side and the underlying technology itself. To really wrap your head around Ethereum, researchers at VanEck's suggest thinking of it like a massive digital mall that lives on the internet. The smart contracts, those are the individual stores. The validators are mall security and property management, and ETH is the exclusive native currency you have to use to do absolutely anything inside this mall, kind of like buying tokens at an arcade. Over the last few years, this digital mall has been undergoing massive structural renovations. In April 2023, we saw post-merge withdrawals enabled. Then, looking ahead to May 2025, the highly anticipated Pectra upgrade goes live. Pectra is crucial because it introduces automatic reward compounding and raises the validator balance ceiling. This actually lifts the staking APR by roughly 1.5% without adding a single drop of extra inflation to the network. And all of this perfectly sets the stage for the absolute behemoth of an upgrade currently slated for the second half of 2026, Glamsterdam. Yes, I know that is the real name, and yes, it is going to fundamentally change how the network operates.
Glamsterdam is arguably the most important technical shift for Ethereum's price mechanics since the merge itself. It bundles deep plumbing changes, like enshrined proposer-builder separation, or EPBS for short, with a major gas repricing that could lower base layer gas fees for standard transfers by up to 71%. Now here is the contrarian view that you really need to grasp. Cheaper Layer 1 gas is actually incredibly bullish for the ETH price. Why? Well, over the last couple of years, Layer 2 networks like Arbitrum and Base have been absorbing all the transaction activity. That caused Ethereum's base layer fee burn to collapse, making the token mildly inflationary. Glamsterdam's massive cost reduction aims to pull all that juicy fee revenue and activity right back down to the base layer. Analysts project that by dropping fees and increasing capacity up to 10,000 transactions per second, this upgrade will push the network back into net deflationary issuance within just 2 quarters of activation.
When you look at historical spikes in daily fees, you realize this isn't a static subscription model. Ethereum charges users based on the computational intensity and the spot demand for block space at any given exact moment. When the network is busy, it simply costs more to get your transaction included in a block. So if Glamsterdam successfully brings all that high-volume institutional activity back to the base layer, those historical spikes in daily fees translate directly into heavy network revenue. And because of Ethereum's mechanics, much of that revenue gets burned, permanently reducing the total supply of Ethereum. It is this brilliant, self-regulating economic loop.
So how does this translate into dollars and cents? Section 4. Ethereum's new business model.
Because Ethereum is evolving so rapidly, it's developing entirely new revenue streams that financial analysts can model just like they would a traditional tech stock. To model Ethereum accurately, we have to understand the revenue split between the network itself and the individual applications built on top of it. VanEck uses a great analogy here. If you buy something at a store in a physical mall, you're essentially paying for the item plus a tiny fraction of that store's monthly rent. On Ethereum, users pay both the application and the network. Take Aave, a decentralized lending protocol, for example. VanEck found that for Aave, the user's cost is split. About 93% goes directly to Aave and its lenders, and a roughly 6.98% take rate goes to Ethereum as the platform fee. As more traditional businesses, we're talking payment processors and cloud infrastructure, deploy onto blockchains to reduce their operating costs, analysts are actively modeling exactly how much of that multi-trillion-dollar economic activity Ethereum will capture through this base take rate.
But listen, transaction fees and take rates, that's only part of the new business model. This brings us to a frankly revolutionary concept, security as a service. Because ETH is a bearer asset on a highly secure network, its value can actually be exported to secure outside applications, oracles, bridges, and entirely new blockchains through projects like EigenLayer. The ETH basically acts as a performance bond. If the outside protocol acts maliciously, the locked ETH is slashed, meaning it's seized or destroyed. Because investors are taking on extra risk to export their ETH this way, VanEck models that they will command a massive risk premium, essentially demanding a 2x multiple on their standard yield. They project that up to 10% of the entire ETH supply could eventually be locked up providing this security as a service. That creates a massive new revenue line and further shrinks the available supply of liquid tokens.
All right, let's look at the actual projections. Section 5. Bear and bull scenarios.
So we have the institutional demand, the deflationary tech upgrades, and these brand new cash flow models. Now, we need to synthesize all this data into the specific price targets laid out by major financial analysts. When you systematically break down the wildly varying targets across the industry, it really shows the crazy spectrum of possibilities. Starting with VanEck's 2030 projections, they actually have a deeply pessimistic macro bear case of just $343, which basically assumes terrible regulatory crackdowns and complete network failure. But their base case is a staggering $11,800, and their institutional bull case is a massive $51,000, which assumes Ethereum captures 90% of the entire global smart contract market. Meanwhile, CryptoRank analysts have planted their flag at a $15,000 base case by 2027, driven entirely by Wall Street stablecoin and real-world asset expansion. And then we have the analysts at Finance Feeds, who took a much more measured, near-term approach for 2027.
So, the crucial point for the more immediate future is that Finance Feeds targets $4,200 as a highly realistic, conservative base case for Q2 2027. And this isn't based on parabolic retail hype or meme coin energy. This $4,200 target is mathematically anchored to three very specific triggers. First, cumulative ETF inflows crossing the $20 billion mark. Second, the successful activation of that Glamstandum upgrade we talked about, restoring net deflationary issuance. And third, the validator entry queue staying bid as those staked ETFs lock up the free float of tokens. They do note a bear case of $2,800 if Glamstandum is delayed or macro interest rates spike, and a stretch bull case of $5,500 if the tech ships early. But $4,200, that is the grounded, institutional baseline they suggest operators should definitively plan against.
Let's wrap this all up. Section 6. The future of finance. We've thrown a lot of complex technical and financial data at you today. Let's bring this explainer home by synthesizing exactly what this data means for the future of global financial settlement. If you take away anything from these institutional models, it absolutely should be these 3 points. First, the regulatory tension is clearing. We're seeing MiCA in Europe pushing euro stablecoins heavily on-chain, and US clarity driving real-world asset tokenization. Wall Street's adoption, it's locked in. Second, the underlying network is heavily optimizing itself. Upgrades like Pectra and Glamsterdam are specifically designed to scale capacity while pulling the big fee revenue back to the base layer. And third, when you combine a network that fundamentally burns its own supply with Wall Street vehicles like the staked ETH-bot ETF that actively hoover up and lock away tokens, you create the perfect conditions for a massive structural supply squeeze. The fundamental error most people make is treating Ethereum like a meme or just a beta trade to Bitcoin. The data shows it's evolving into a hybrid asset, a yield-bearing, deflationary duration asset that underpins the next generation of financial infrastructure. Understanding this shift is absolutely critical for anyone navigating the digital asset space over the next 5 years.
The data clearly points to a massive repricing event, but we want to hear from you. After looking at the ETF inflows, the upcoming Glamsterdam upgrade, and the varying institutional models we covered today, what is your ETH target for 2027? Do you lean toward the conservative $4,200 base case from Finance Feeds, or are you looking at that $15,000 Wall Street bull run projection? Let us know in the comments below. We read them all and love to see the debate. And hey, if you found this explainer valuable and you want more deep dives into the data shaping our financial future, please hit that like button, subscribe to the channel, and turn on notifications so you never miss an update. It really helps us out. Thanks so much for learning with us, and we'll see you in the next explainer.